All right, let's dive right in. Today, we're going to decode something that sounds complicated but is actually super insightful. It's called the term structure of interest rates, but you can think of it as the DNA of the bond market. It's this amazing tool that basically lets us peek into the market's collective brain to see what it expects for the future of the economy.
So here's our game plan. First, we're going to learn the lingo, the key vocabulary. Then, we'll see how to actually visualize all this stuff with yield curves. After that, we'll get into the theories behind why the curves look the way they do. We'll actually run a calculation to make it real, and then we'll wrap up with some modern tools and the big takeaways. Sound good? Let's go.
Okay, first things first. Before we can build anything, we need to lay the foundation. And in this world, that means getting a handle on two absolutely critical terms. Everything else we talk about is going to build on these two ideas.
So, what is the term structure? Imagine you could walk into a bank and ask, hey, what's the interest rate for a 1-year loan? What about a 5-year, a 30-year? That list of different interest rates for different lengths of time, all at this one single moment. Well, that's it. That's the term structure. It's just a snapshot in time.
Now, a spot rate, this is the purest, cleanest interest rate you can find. Why? Because it comes from a special kind of bond, a zero-coupon bond, that only makes one single payment at the very end. There are no little interest payments along the way to muddy the waters. So it gives us the true, unclouded interest rate for one specific point in the future.
And a forward rate? This is pretty cool. It's like the market's pre-order price on a loan. Using the spot rates we have today, we can figure out what the market thinks the interest rate will be for, say, a 1-year loan that doesn't even start for another 2 years. You're locking in a future rate, right now. Okay, so we've got the vocabulary down. Now for the fun part. What happens when we take all these rates and just plot them on a graph? Well, we get something called a yield curve, and it tells this incredible visual story about where the economy might be headed.
And this is the absolute key. The shape of that line, that curve, is not random at all. Whether it's sloping up, sloping down, or just dead flat, it's a powerful, immediate visual clue about what the market is thinking. It's a forecast in picture form.
Now this is where it gets really interesting. Look at that first row. If the spot curve is sloping up, meaning long-term rates are higher than short-term ones, the math tells us that the forward rates have to be even higher than the spot curve. The market is literally pricing in an expectation that rates are going to rise in the future. And of course, the opposite is true if the curve is sloping down.
So this brings up a really good practical question, right? Most bonds out there in the real world are not zero-coupon bonds. They pay regular interest. So how in the world do we get these pure, clean spot rates from the messy reality of the bond market?
We do it with this really clever process called bootstrapping. You start with the easiest one, the shortest-term bond, where its yield pretty much is the spot rate. Then you use that known rate as a building block to figure out the next spot rate in line. You just keep repeating the process, climbing up the ladder one rung at a time until you've built out the entire curve.
So we know what the curves look like and how to build them. But the big question is, why? Why do they take these shapes in the first place? Well, this next section gets into the different theories that try to explain the forces behind it all.
You know, there are a few different schools of thought. The liquidity preference theory is simple. Investors demand to be paid more, a premium, to lock up their money for a longer time. The segmented markets theory says that the market for short-term bonds and long-term bonds are basically separate worlds. And then the preferred habitat theory is kind of a mix, saying investors prefer a certain time frame, but you can tempt them to move if you offer a high enough yield. And this quote, this is really the whole game for professional investors. They are basically making a bet. They're betting that the market's forecast, which is embedded in that forward curve, is wrong. They think they know better, and they build their entire strategy around trying to profit from that difference.
So here's a classic strategy that comes from this. It's called riding the yield curve. Let's say the curve is sloping up. You buy a 10-year bond, but you only plan to hold it for 2 years. As time passes, your 10-year bond becomes an 8-year bond. It rolls down that hill to a lower yield. And what do we know? Lower yield means a higher price. So you get a capital gain just from the passage of time. Pretty neat.
Okay, enough theory. I think it's time to get our hands dirty and make this stuff tangible. Let's actually put the math to work and use these concepts to solve a real-world type of problem.
So here's the puzzle. The market is telling us the rate for 1 year is 9%, and the rate for 2 years is 10%. Based only on that information, what is the market implying the 1-year interest rate will be 1 year from today?
To figure this out, we use the forward rate model. And the core idea here is something called no arbitrage, which is a fancy way of saying there's no free lunch. The return you get from investing for 2 years straight has to equal the return you'd get from investing for 1 year and then reinvesting that money for a second year at the forward rate. The two paths have to lead to the same result.
So all we have to do is plug in the numbers we know. We've got our 10% and our 9%. Then it's just a little bit of algebra to rearrange the formula and solve for the one piece we're missing, that f of 1, 1, which is our 1-year rate 1 year from now.
And there it is, 11.01%. So based on today's rates, the market is basically saying it expects a 1-year loan starting a year from now will cost just over 11%. Now this isn't a crystal ball, but it is the forecast that is baked right into today's prices. All right, let's zoom out and wrap things up by looking at the bigger picture. In this last section, we'll hit on a couple of modern tools professionals use and really hammer home the most important takeaways from all this.
You know, we've talked a lot about government bonds, but in today's global financial system, the swap curve is often what the pros really look at. And why is that? Well, it's because the swap market is just massive, it's super liquid, and it gives a much more apples-to-apples comparison between different countries.
And this is just so elegant. You can take all the complex, chaotic, day-to-day movements of the yield curve and break them down into just 3 simple moves. The first is level. That's the whole curve just shifting up or down together. And get this, that alone explains over 75% of all the changes. The rest is basically just a change in steepness, like a twist, and a change in curvature, which is a little bend in the middle.
So, if you take away just one thing from all this, let it be this. The term structure, the yield curve, it's not some abstract thing for academics. It is a real-time forecast for the economy, generated by the collective wisdom or madness of the entire market. Learning to read it is like learning to read the economic weather report.
And that leaves us with one final thought, a question for you. You now have the tools to read this incredibly powerful signal, so I encourage you go look up the current yield curve. Given everything we've talked about, what story is it telling you about our economy right now?